Hi, it's Josh Young with Bison Interests, and this is an oil market update and an outlook on our portfolio as of March 2026. As a reminder, none of this is an offer, solicitation, or recommendation. Please take a close look at the disclaimer. So a little background on Bison. If you're listening to this, you're probably somewhat familiar with this, but we were launched close to 11 years ago. We focus on publicly traded oil and gas companies, and we've done quite well versus various relevant indexes and ETFs, such as XOP, the large producer ETF, the flat price WTI for oil, and then also the S&P 600 Energy Index, which has a ETF PSCE. I'm going to walk through oil supply fundamentals, oil demand fundamentals, an update on what's happening in the Middle East and the risk to the global oil supply, and then some discussion of what we're up to specifically at Bison and how we're capitalizing on that. So, unlike what we were being told by various pundits and investment banks and government and non-governmental organizations, the global oil market was actually pretty closely in balance for the last few years, with supply and demand matching quite tightly and with inventory levels actually quite low, despite many folks forecasting a glut or a super glut, and with numbers from the EIA and IEA forecast for a close to 4 million barrel a day build in the first part of this year. And prior to the current war and crisis in the Strait of Hormuz, there were just not those builds, which is a giant difference between the forecast and reality. Again, the super glut is just not materializing. You can look at various different measures of inventories. You can even see on the bottom left, I showed where some of this super glut narrative was showing up. And you can see even from this chart from Goldman Sachs, which was extremely bearish oil coming into 2026, forecasting a giant glut, and from Bloomberg and various other folks. So anyway, I think this was originally a Bloomberg chart that Goldman incorporated, and now we're incorporating. And if you look at the left y-axis, it's much larger than the right y-axis. So again, this is sort of a chart crime. And the goal of it, I think, was to show that there was a tremendous amount of sanctioned oil on the water. And what it accidentally also showed was that the amount of sanctioned oil on the water was actually quite low, measured on the right y-axis, versus total inventory is actually falling based on the left axis, the left y-axis. And then you can also see that for both, starting in 2026, inventory levels were actually falling. So again, there was sort of this very intense narrative, and the reality was quite different coming into this crisis. So I think this is important because there's various forecasts of what prices should be or would have been, and my forecast at that time, my understanding was consistent with the reality, which was very different from this consensus and is quite promising both for the short-term price for oil and natural gas, and particularly oil, but also I think is helpful in understanding sort of how we got to this situation where there could be this sort of extreme price move and what prices might be like after the situation's resolved. Supply again was already starting to roll over. OPEC Plus was missing their quotas by quite a bit. They had increased production over the course of 2025, but they had increased their production quotas more, and they were missing, and production was starting to fall ahead of this quite substantially. And then the EIA, likely on the back of their forecast of much lower oil prices, was forecasting that U.S. oil production would go into decline, and U.S. oil production had already declined for a few months prior to the Strait of Hormuz crisis. One of the traditional factors that analysts use and used to track what U.S. oil production and global oil production might be was to track the rig count. And on the top right, you can see the U.S. oil-directed rig count over the last few years. And I'd say the biggest pushback I get when I talk about this is that rigs are getting more efficient and that there's more production per foot from wells. And so this is just not true anymore. Unfortunately, rig efficiency gains are really slowing, and to the extent that we see more rigs come on in response to this much higher spot oil price, we're going to see, I think, substantial disefficiencies as we bring back on rigs that weren't in operation and that are very inefficient for a while as they ramp up. But on the bottom chart, I'm showing the gas well productivity per foot, where the narrative has been that the gas wells have actually held in there a lot better on a well productivity basis versus the oil wells. And on a per foot basis, gas well productivity fell quite a bit from 2021 all the way through 2025. So even more so, oil well productivity fell. But again, even on the gas side, the change was pretty extreme. And I think that contrasts with the common perception, essentially misperception, that the falling rig count doesn't impact the likely future supply trajectory. Similarly, the low level of global capital expenditures, even on an inflation-adjusted basis, has led to what you can see on the top right, which is a collapse in oil and gas discoveries in the last few years. And what that means is, as we have all-time high oil production prior to the current crisis, but not all-time high discoveries, as you can see again above in that top right, what you're seeing is depletion of existing reserves and of prior historical discoveries without replenishment, essentially burning the furniture to keep warm. And so what you're going to need to see, I think, is much more investment in global capital expenditure for many years, as indicated on the bottom chart. Again, that expenditure has been way too low. People have been relying for too long on efficiency gains and improved well performance, and we're in the process of that inflecting lower. And so we're going to need more exploration, more delineation, and frankly, even more development activity as the low-hanging fruit has been picked pretty substantially. So now moving on to oil demand fundamentals. One of the questions I'm asked most, in addition to the questions around drilling rig efficiency and well productivity, is on the future of oil demand. I'm often asked, hey, isn't that going away? And the long-term trend is actually quite positive. And even the short-term trend over the last year or so has blown the lights out, with short-term oil demand growth pre-crisis showing up close to 2 million barrels a day, close to 2% annual global growth of oil and petroleum liquids demand, which is again in excess of this long-term trend. And there had been quite robust demand from incremental and marginal consumers like China, where there had been narratives about China collapsing and various other things, China electrification. And instead, what we've seen is that China's demand has been growing along with world demand for oil. And so again, my message would be that oil isn't going anywhere from a demand perspective. Perhaps if we get into demand destruction type pricing at much, much higher levels and stay there for a while, demand may be hit like we saw in the late 1970s and early 1980s, when oil prices went to inflation adjusted all-time highs and way beyond prior levels of price, which would be in today's prices to do that in the sort of $200 plus a barrel range for WTI oil. So am I calling for that? I don't know. It's possible, especially if the Strait of Hormuz stays blocked for a while. But there is this trend of slowing production growth and rising demand. And the bet at Bison has been over time that lower supply growth and higher demand growth over time would meet and lead to much higher prices for a multi-year period. That's how we're positioned. That's what we've been betting on. And so far, so good. One of the big drivers of this demand growth is that there's a huge difference in oil consumption in wealthy countries and other countries. The US is somewhat of an anomaly. We consume a lot more oil per capita than almost every other country in the world. But as you look at the wealth curve, as countries get wealthier, even as they fully electrify, like some of the Scandinavian countries have, their per capita consumption of oil rises a lot. And so the constraints on oil demand in countries like China and India and elsewhere seem to be most highly correlated with wealth. And so as these countries grow, as more and more people come out of poverty into a lower middle class and then fully into the middle class, you end up seeing substantial demand growth. And you don't have to underwrite people in India or China consuming as much oil as we do here in the US. You can underwrite them to, again, societies where people have nearly fully electrified transportation and nearly fully electrified a number of other things, and where they're still using 2 or 3 or 4 times as much oil per capita as countries like China. So there's a long ramp of oil demand consumption into the future, even at potentially higher prices. So now for, I guess, the good stuff or the terrible stuff, depending on your perspective. Good for price, bad for potentially demand, horrible from a humanitarian perspective. The Strait of Hormuz is net effectively blocked. There are many experts out there saying it's not closed, but from our perspective at Bison, we care about making money more than sounding smart or being right. And so net effectively with exports through the strait and transits through the strait down by more than 90%, even over the last week or so, that's to us net effectively closed. And in addition to that closure, there's been attacks on energy infrastructure in the region. And then there have been some shutdowns, partially because of the attacks on the infrastructure and partially because with limited capacity to export due to the blockage of the Strait of Hormuz, some of these fields, they're running out of local storage and they're running out of essentially places to put their oil and natural gas. And so they're forced to shut in. In some cases, it could take weeks or even months to bring production back on and bring exports back on. And it is worth noting that there's continued attacks both on tankers, again, unfortunately, as well as on energy infrastructure, which could lead to a much longer delay in the ramp back up in production after this crisis ends, when it ends, hopefully soon. And so the one other thing to call out here is that we were already seeing OPEC plus countries miss their production quotas. So OPEC plus trying to ramp production after this is over, one, may have problems because these fields were attacked and export infrastructure has been attacked. Two, that it may take some time for them to ramp back up. But three, most importantly, a number of these OPEC plus countries were already at their spare capacity limit. And so there are real questions about how much spare capacity is left, perhaps not much. And so an attempt by OPEC plus to try to ramp production on the backside of this crisis to try to adequately supply the market may be challenged. And so this may actually lead to much higher oil prices for some time, which is a variant view. The consensus is that this will not last very long. If you look at the oil forward curve, it's not pricing much in. Iranian oil exports are also effectively blocked. As you can see, in the first Trump administration, Trump enforced sanctions and Iranian oil production fell quite a bit. And then sanctions were loosened and under the following administration and production ramped. And then it actually continued to ramp into Trump's second presidential administration up until recently. And the numbers are actually staggering. Iran was back up to a 46-year production high when you include natural gas liquids and condensate in addition to crude oil, at a level measured by Bloomberg of 5.5 million barrels per day of oil and petroleum liquids. And so the impact in a 106 million barrel a day supply and demand world of potentially millions of barrels a day coming offline could be quite significant, even if there wasn't this Strait of Hormuz blockage. Again, one of the potentially likely outcomes of all of this is that there's some sort of civil war or messy transition politically in Iran. And if you look at the last time that happened in Iran in the late 1970s, production fell from around current levels to as low as close to, 1 million barrels a day, 1.5 million barrels a day. So there's room for production in Iran to fall potentially by 4 million barrels a day if past its prologue. And just that would be almost impossible for the world to make up over the short to even medium term. It could take years to ramp that much production, and that would require essentially demand destruction pricing, which is, again, like we were talking about in that 1979, similar to Iran's production collapsing in 79, leading to all-time inflation-adjusted high oil prices. A similar sort of collapse could lead to that, even if the Strait of Hormuz blockage is undone in a short amount of time. And so we tried to show some different scenarios. Again, I actually think like the price that oil could go to is much higher. Not sure how high it could actually go or stay, or how long it could stay there, but the potential is, again, inflation adjusted all-time highs, which would be maybe even twice what we're showing on the scale. If Iranian oil is out for a while, again, probably understating this, but 80 seems like a good sort of starting point in terms of thinking about it. The base case is continued oil flows. That base case is mostly out the door, but we'll see. And I think it's helpful to think through these sorts of things because we're positioned, I think, to do well on a multi-year basis in that base case. And hopefully we're positioned, and we'll see, to do extraordinarily well in some of these higher price scenarios. But we're also not going crazy, and it's not like all of the money is in, super levered positions that'll, either pay off a lot or go to zero. We have a little bit of exposure like that, but the bulk of our assets are invested in companies that we think should do quite well over time, even in this sort of base case scenario. So now just a little bit about what we're up to. So again, the returns for this strategy have been phenomenal. It's been a very difficult time to be an oil and gas investor for most of the time that we launched Bison. We launched Bison because in 2015, almost everyone that we knew that was in the public equity oil and gas space was getting out of it. And so the thought was that there would be room to potentially materially outperform through stock selection, through focusing on companies with good management teams, survivable balance sheets, cash flowing assets at large discounts to their intrinsic value based on our estimates, and then also with identifiable catalysts to unlock value. And I think the best comp versus the strategy is the S&P 600 Energy Index, which is the PSCE ETF. And I will note this is as of end of February, so before the Strait of Hormuz got blocked, before the war started, at least from a market perspective. I think the last date was the 27th or so of February, which was before Iran was attacked. So these things are up a lot since then. So we thought about different ways to show just how cheap what we own is, like what's driven that almost 200% difference between PSCE down 55% or so since we launched, and the fund and strategy up over 140% net since we launched. And one of the ways to show it is that we buy stocks that are very cheap, measured on production, measured on reserves. These aren't the only measures. We're not sure that using just a pure quantitative screen would accomplish what we've accomplished or would be great going forward. There's lots of companies that look cheap that are problematic. But we do think that owning cheap stocks is a good recipe for garnering excess returns. As the co-founder, former CEO for Bison used to say, you make your money on the buy. And so XLE, you buy into XLE per $1 million, you get 16 BOEs a day, you get a certain amount of reserves in the ground, and then in XOP, you get 22 BOEs a day of barrels of oil equivalent a day. Per $1 million, you get 59,500 BOEs in the ground. S&P 600 Energy Index, PSCE ETF, you buy that, $1 million of that, you get 40 barrels of oil equivalent a day and 137,000 barrels of oil equivalent in the ground. And then in our top 5 positions at Bison, you you put $1 million in and you get 65 BOEs a day. So essentially 4 times more BOEs a day in our portfolio than in XLE, and 50% more than in PSCE. And then similar in terms of reserves, where it's essentially close to 5 times the reserves that we get per $1 million at Bison versus XLE. This may change. I wouldn't rely on this. The goal of this isn't to be precise on it. I know we have some significant figures there, but we probably should have just rounded them. The point is to show the difference in value, which I view as a key contributor to outperformance. Past performance may not be indicative, but I would way rather buy a bunch of stuff on the right of this chart than a bunch of stuff on the left of this chart. Paying 4 or 5 times more for something because it's bigger or because people like it more or something, to me, even if it's advantaged, it to me seems like a recipe to not do so great. Similarly, looking at the reserve value based on the standardized measure of cash flow in the SEC filings and equivalent foreign filings for foreign listed companies, $1 million investment in XLE gives you $442,000 of proved reserves discounted at a 10% discount rate, versus Bison, $1 million would get you, again, as of this measurement, as of end of last month, this is all changing in real time, and the reserve values are also changing in real time. But these $1 million would get you almost $8 million of PV10 reserve value. So huge difference, and it's not. There's lots of complexity, but simply buying more reserves and more valuable reserves for less money has been a recipe overall, with lots of volatility, to material outperformance versus the other publicly traded mechanisms for exposure to the oil and gas sector. So I'm going to walk through a little of what some of our large positions look like on a no-names basis in terms of upside to higher oil prices, and then upside to their net asset value at not current prices, at prices prior to the current situation. So at $60 oil, one of these large positions, the NAV on a 2P basis, so proved and probable, is $31 a share versus $10 a share price. These were normalized to $10. And then similarly, the upside from a normalized price here to $100 is, in theory, just using the multiple when it was at 70 versus that same multiple if oil went to 100 and stayed there. There's 223% measured upside in this position just if oil went to that price and stayed there. This is not a price forecast. This is not meant to guide specific returns. It's just an exercise in displaying cheapness of these positions and just how compelling we find them in a market where buying large cap oil and gas stocks may actually embed a negative return without significantly higher prices. So this is very different, and it's sort of fun to be able to show in real time, hey, here's what could happen, and here's what could happen with some of these other ones, and sort of where those excess returns over the last almost 11 years for this strategy have been garnered. Similarly, this company trades at a large discount on free cash flow to peers based on recent but not current commodity prices. So much lower prices, much higher free cash flow yield. I think that implies a much higher, even higher free cash flow yield at much higher oil prices. And then similarly, if it maintained its multiple, it would imply a 150+% return from here at $100 oil. And this measure doesn't really show compounded returns, so I actually think there's more upside than that, because at higher oil prices, these guys don't just make more money. They pay off debt a lot faster, but then they also accelerate development. They get access to inventory that they might not have been able to address, and they get the opportunity to compound production, reserves, and cash flow. This is an uncompounded number, and again, these comps in many cases actually might imply negative returns at even higher oil prices because of the expensiveness on a production and cash flow basis, like I showed before, and because of the expensiveness relative to the booked reserve value for those companies versus their current share prices and enterprise values. And this third one, similar idea, high free cash flow yield at a big discount to its liquidation value, big discount to its replacement cost. And then we really like owning companies that have been paying off a lot of debt. In this case, the amount of debt that it's paid off is extraordinary, and that's leading to huge potential upside. Just as the market begins to reflect that on the sort of Miller-Modigliani theorem, what we found is that companies that are serial debt repayers like this one, the market ignores them for a while, and then it's hard to know exactly when, so we tend to buy them early, and that shows up in some of our return volatility and also some underperformance in these sorts of things early on. But we'd rather buy them early and be there for it. And as they go, sometimes it's at 2 times debt to cash flow, sometimes it's at 1 times debt to cash flow, sometimes it's when they announce that they're starting to pay a dividend or buy back a lot of stock. Hard to tell, but as that happens, as that inflection occurs, these companies' shares often end up more than making up for all the debt that's paid down. So this one has essentially an embedded double or triple in it, potentially just from the debt that's been paid down so far in the last few years. And then it has a lot of potential upside as it does eventually turn to reactivating wells, to reactivating rigs, to whatever in terms of its specific business, and then going and buying back shares and paying dividends. It's not necessarily the share buybacks or dividends that pay us. Those are nice, and sometimes we'll hang on to companies if they're buying back an extraordinary amount of stock at a large discount to intrinsic value, or similarly on the dividend side. It's more that shift from debt pay down and sort of stasis to massive capital returns tends to re-rate the stocks over a period of time. And this one also just shows massive potential upside. So please don't hesitate to reach out if you want to chat more about what we're up to. Hopefully that this has been helpful and productive, and we appreciate your interest and hope to connect with you soon. Thank you.